John Higgins, Mortgage One. Happy Monday. So last week, not a bad week as far as rates go. We did see a little bit of easing, not much, but all in all, we continue to remain in a band here between 4% on the 10-year Treasury and 4.32. And this week is a huge week. We've got all kinds of employment numbers coming out. One of the issues that the Fed has been fighting, they've raised rates 11 times over the last couple of years with the idea of kind of curtailing the economy, which we're still running above expectations, which is great for the real estate industry because we need a healthy economy for a good real estate industry. And then the Fed is really trying to break employment. We've seen employment numbers at just historic highs month after month. Jobless claims have not really moved off very low lows. This week we get the jobs number on Friday, and that's going to be kind of the ramp up for the entire week. Rates will probably be trending mostly sideways in advance of that number. Until we see the Fed get a hold of the employment numbers and kind of force them to more moderate levels, not necessarily shedding jobs in the economy, but at least not hitting these highs, 250, 350,000 that we've seen the last number of months, and then have the economy kind of shrink a bit. Last week we did have a good inflation print from the Fed's favorite gauge of inflation, the PCE. We're down to 2.8. That is getting much closer to the Fed's 2% target. And, when we saw rates at, 7-8%, as far as inflation goes, and now we're all the way down to 2.8. Obviously, the Fed's increases have had a significant impact on inflation, but that only tells part of the story as far as why our mortgage interest rates continue to remain stubbornly high. We're stuck right around 7%. Again, this week with the jobs number coming out will give us another indication, if we get a chance to maybe break a little bit lower. The Fed is still looking at 3 rate cuts this year, but every month that goes by and we have robust jobs numbers and the economy continues to, trend higher than expected, kind of puts a little bit of a cold shiver in the idea that the Fed's going to cut a full 3 times this year. And that's, again, why our rates have kind of bounced from the beginning of the year back up to the 7% level. So we'll give you an update next week after the all-important jobs number. We'll talk to you then.